In this second video, we'll finish problem number 9-11, which we were talking about at the end of the last video. We did the first part, year 2021, in the last video. In this video, we'll go on to 2022 in the problem. And here I have changed the data a little bit. So in 2022, I've changed the index from 1.1 to 1.2. Otherwise, yeah, all the valuations are the same. The process is very similar, except now we have one more layer. So we're going to deflate the end-of-year retail prices of our inventory. We're going to deflate that to the base year retail prices. So what we're essentially doing is we're taking the $63,800 and we're deflating them back to the price it would have been at retail at the beginning of 2021, which is when we began the LIFO process. So we're deflating it back then essentially 2 years, all of 2022 and all of 2021, back to our base starting point, which is January 1st, 2021. And so the index for cost to retail remained the same, except now we have to calculate a third cost to retail percentage. And that third cost to retail percentage, again, is going to be the goods available for sale, excluding beginning inventory, and we'll take the cost versus the retail of those values, divide the cost into the retail, and we have 77.21%. So we have a different cost to retail percentage each year. Otherwise, we'll just repeat the process that I demonstrated in the earlier video, and we will then calculate our 41,972 by adjusting each row, each year or layer to both the consumer price index as well as to the appropriate cost to retail percentage. And that will give us our estimate of ending inventory and cost of goods sold. In problem 9.14, we're going to calculate the effect of change in accounting method from the FIFO method to the average method, a liberal approach to a more conservative approach. I've changed some of the values in this problem. I've changed the effective tax rate and I've changed the beginning inventory under FIFO. The objective of this problem is to calculate the difference between ending inventory and cost of goods sold under the two methods. So I recommend calculating each separately first, then comparing them. So one of the first things we'll do is we're going to calculate under the FIFO method first. So what is our cost of goods sold and our ending inventory under FIFO? Well, using my numbers, I've got 5,167 units times $30 gives 155,000 beginning inventory under FIFO. And then I have a couple of purchases at different prices. I'll multiply each of those together, and that will give me my new inventory. Then I have sales. So once I have my sales determined, I can now calculate my cost of goods sold. Well, under FIFO, I've got a total of 535,000 in inventory, just adding 155 plus 180 plus 200, cost of my inventory. So my process here is first calculating the cost of goods sold and the ending inventory under FIFO. I'll do the average later. All right, so continuing on, for my cost of goods sold under FIFO, I'm going to essentially multiply the 5,167. Remember, I've got 8,000 units to deal with, right? I've sold 8,000. 5,167 of those will be costed at $30 each. The remaining 2,833 units will be costed at $36, which is the additional number I'll need to get to 8,000. I'll just add those two products together, and that will give me then my cost of goods sold. I will have sold 8,000 units, 5,167 at 30, and then the other 2,833 units will be costed at $36. And again, I got that value by taking 5,000 and then subtracting my number of units left, and that gives me 2,833. So these are the numbers sold. And that'll supplement the 5,000 I sold from beginning, 5,167 I sold from beginning inventory. and I'll add those two up, and that should give me then the 8,000 units sold, and we're good. So now I've costed my sales under the FIFO method. All right, now that I have my cost of goods sold under FIFO, I can determine what my ending inventory is under FIFO. And I do that by subtracting or deducting what was available minus what was sold. So I have my ending inventory calculation here of 278, which again is taking the 2,167 left in the $36 layer. I've only got 2,167 unsold, that's what's left, plus my 5,000 at $40. So my ending inventory under FIFO is 2,167 times 36 plus 5,000 times 40. I now have my cost of goods sold and my estimate for ending inventory under the FIFO method complete. Now let's move over to the average cost method, which is the method we're switching to. First step in the average cost method calculation is to determine the average cost per unit. So the average cost per unit then will be the total value of my inventory under the average cost method. So my numerator in this calculation will be 130,000 plus 200,000 plus 180,000. You'll notice I do not use the 155 beginning inventory because that's what it would have been under FIFO. They're giving us the 130,000 beginning inventory under the average method. So I just need to add that to my two purchases. And just divide that by the total number of units, 15,167 using my numbers. That'll give you the average cost per unit under the periodic method. Once I have the average cost per unit, I just need to multiply the 3363 average cost per unit times my 8,000 units sold. That'll give you my cost of goods sold under the average costing method. Once I have that value, now I can estimate or determine my estimate for the ending inventory under the average cost method. And that's just a matter of taking the 7167 ending units in inventory times the 3363 average cost per unit. So I had 7,167 units left. Multiply that by the $33.63 average cost per unit, and I have a cost of goods sold under the average method of 241,000. And the difference between the two then, cost of goods sold is $12,011 using my numbers. The average cost makes sense, results in a greater cost of goods sold than it would under the FIFO method, since with prices rising, FIFO would give us the least cost of goods sold, and average would give us a greater cost of goods sold. So that makes sense and works out. As far as the journal entry is concerned, all they're looking for here is restating, since we're changing accounting methods and we're changing from FIFO to the average method, we're going to use a retroactive adjustment. And so that means we're going to make a debit into retained earnings of $25,000, and inventory gets reduced or credited by $25,000. And where do we get the $25,000? That'll be the difference between $155,000 and $130,000 beginning inventory values. So that's the adjustment that we're making in this problem. That's a retroactive adjustment for the difference in beginning inventory under the FIFO and average cost methods. And then the last couple of comments I wanted to make is that you're going to be facing a problem in Connect that asks you to analyze the effect of errors. And just a little hint on that particular problem. And that is that you should use the cost of goods sold formula. And that cost of goods formula, as you recall, is cost of goods sold equals beginning inventory plus purchases plus any freight, and then you'll subtract from that ending inventory. If you use this formula when you're trying to determine the effect of errors, it makes the analysis much easier. So let me enlarge this a little bit, and let's talk a little bit about an example. All right, if you'll notice the signs on each of these values, cost of goods sold is positive, since there's no negative sign in front of it. That's also true with beginning inventory, purchases, and freight. However, ending inventory has a negative sign in front of it. So any change to the ending inventory would have the opposite effect on cost of goods sold. So let's run through an example. Here's an error. Beginning inventory is overstated by, well, let's say $400. All right, so if beginning inventory is overstated by $400, what effect will that have on cost of goods sold? Well, let's look at our equation. If beginning inventory is too high by $400, mathematically that means cost of goods sold has to be overstated by the same amount, $400. So here we have overstated on beginning inventory, and that's going to have the exact same effect on cost of goods sold. Because again, as we look at our formula, in order to maintain that equality sign, they both have an assumed plus sign in front of them, since there's no negative sign. So whatever we do to one side, we have to do the other. So if we're saying beginning inventory is overstated as an error by $400, that means cost of goods sold must be overstated by $400. All right, let's do another error. So this will be error 1. Error 2, let's state that we now have an overstatement of ending inventory. Ending inventory is now overstated, not beginning inventory. So I'm going to change this to ending inventory is overstated by $400. What effect will that have on cost of goods sold? Well, let's look at the formula again. Cost of goods sold equals beginning inventory plus purchases plus freight, and of course you could include returns and other things in here as well, minus ending inventory. Well, if they're saying that ending inventory, this last item, is overstated, what effect will that have on cost of goods sold? It would have the opposite effect on cost of goods sold, because cost of goods sold is a positive value and ending inventory is a negative value. So to maintain this equality between both sides of the equation, then if ending inventory is overstated by $400, cost of goods sold has to be understated by $400 by the same amount. And it's because of that sign in front of it. Now let's look at the effect of these two transactions on net income. Well, the effect of cost of goods sold will give us a hint here. On the first case, we had beginning inventory overstated by $400. That means we had overstated cost of goods sold by $400. Anytime an expense or cost is overstated, the effect of net income of that error then will be to understate net income. If you've overstated an expense, then you've understated net income because you've taken out too much out of your revenue. You've netted out too much. So the effect on net income is it's too small. Now let's look at the next change. The inventory is overstated by $400. Well, as we said, if ending inventory is overstated by $400, cost of goods sold is understated. So what happens when we understate a cost on net income? We will overstate net income, right? Because we haven't included enough expenses. We didn't bring over enough cost of goods sold to the income statement. If it didn't cost our income enough, then we're going to overstate net income. And finally, they may ask you, well, what is the effect on retained earnings? Well, the effect on retained earnings is going to be identical to the effect on net income, right? Because we close net income every reporting period into retained earnings. That's where we close it. So the effect of net income will be identical to the effect of retained earnings. So these two columns then will be identical. So that's an overview then, using the inventory formula, determine the effect of errors on cost of goods sold, on net income, and of course on retained earnings. Any questions on these or any of the concepts discussed in Chapter 9, please let me know.